Usually when you want to know how the global economy is doing, you just, look at a stock chart.
Right, you just look for a green line going up.
Exactly. A green line going up or a red line going down. And there's this expectation of simplicity, like reading a thermostat. The market is up, so things are good.
Yeah, we all like those clear signals we can categorize over our morning coffee.
Right. But that binary view is actually what gets people into a lot of trouble.
Oh, entirely. Because if you really want to know what's happening underneath that surface, you have to look at the plumbing. The hidden pipes where the actual risk is being transferred and managed and traded by the institutions that actually move the needle.
The one's really running the show.
Exactly. And once you look there, suddenly that simple green or red line is just gone. You are looking at this massive, incredibly complex pressure system.
Well, today, our mission is to map that exact pressure system. So we have this massive stack of consolidated financial tables, an official press release, and some CEO commentary from a major event dropping today, July 22, 2026.
And that is the Q2 earnings report from CME Group.
Yes, it is. So we are looking directly at the financial plumbing of the world's leading derivatives marketplace, basically to understand how global capital is moving right this very second.
And, I think it's important to frame this for the listener. Analyzing CME Group isn't just about looking at a single company's profit and loss statement.
Right. It's not like analyzing a tech stock or a retail chain.
No, not at all. When you look at their balance sheet, you are literally observing how the world's largest institutions, so banks, asset managers, multinational corporations, how they are managing their risk in real time.
It's like a real-time anxiety meter for the global economy.
Exactly. It's an incredibly unique vantage point into the strategies of global capital.
Well, to understand their current footprint, we first have to establish just the sheer volume of capital flowing through their systems, because we are looking at a frankly record-breaking scale for the first half of this year.
Unprecedented, really.
Right. The raw top-line numbers for the second quarter alone are just massive. So Q2 revenue hit $1.7 billion. Operating income sits at $1.1 billion. And then we have adjusted net income coming in at $1.1 billion and adjusted diluted earnings per share at 2.99.
That's a lot of billions.
It is. But before we go further, help me decode that last metric. When a company specifically highlights adjusted diluted earnings per share, what are they actually trying to show us?
Yeah, so they're basically trying to give you the cleanest possible picture of their core operational profitability. The adjusted part just means they're stripping out one-time accounting noise.
Like what, for example?
Maybe a weird tax benefit or a restructuring cost that doesn't really reflect the day-to-day business.
Got it. So filtering out the anomalies.
Right. And then the diluted part means they are factoring in every possible share that could exist. So if executives exercise all their stock options or convertible bonds turn into stock, the pie gets sliced into more pieces.
So it's kind of a worst-case scenario for the share count.
Exactly. Adjusted diluted EPS is management basically saying, if you look at our core business and assume the most conservative number of shares, this is the exact profit we generated per share. And at 2.99, it paints a picture of a highly efficient cash-generating machine.
Well, the CEO, Terry Duffy, clearly agrees with that. Because he stated, and I quote, "The first half of 2026 was the strongest in CME Group's history."
And the numbers back that up.
They really do. They delivered record performance across revenue, operating income, and EPS for the first half of the year. And looking at the tables, a lot of that is just powered by sheer, unrelenting volume.
Oh, the volume numbers are staggering.
Yeah, in Q2, their average daily volume, or ADV, hit 29.8 million contracts.
Almost 30 million contracts a day.
Every single day. That is the third highest quarterly volume they have ever recorded. And out of that 29.8 million, 9.1 million were non-U.S. contracts, which just goes to show how global this platform really is.
The scale of nearly 30 million contracts changing hands every single day is mind-blowing when you consider what a futures contract actually represents.
Right. It's not a meme stock.
No, this isn't someone buying a fraction of a share on a retail trading app. These are massive, highly leveraged agreements to buy or sell assets at a future date. It requires serious capital and, frankly, serious institutional intent.
But, if you look at these volume numbers contextually, you have to ask yourself a question here. Because Duffy mentioned Q1 was an all-time record, and the tables show Q1 was at a staggering 36.2 million daily contracts.
Right.
Now, Q2 is at 29.8 million, so sure, it's their second highest Q2 ever, but it is a noticeable step down from the first quarter. So are we seeing the markets cooling off? Or is this just a permanently elevated new normal for market volatility?
It's definitely the latter. I mean, what's fascinating here is that back-to-back near-record quarters indicate something much deeper than just a temporary panic.
How so?
Well, historically, if you see one massive spike in trading volume, you can kind of write that off as a one-off shock. A sudden interest rate hike, a geopolitical conflict, maybe a localized banking crisis.
The classic market freakout.
Exactly. We've all seen it. Institutions panic, they rush to hedge their portfolios, volume spikes, and then, a few weeks later, it just settles back down to historical averages.
But we aren't seeing it settle down.
No, we aren't. Seeing a first quarter with 36 million contracts a day, followed immediately by a second quarter with nearly 30 million a day, that tells a different story. That indicates a structural reliance on derivatives by institutions.
Like it's baked into the system now.
Exactly. It means that managing risk at this massive scale is no longer reactionary. It's become a permanent daily requirement for global capital. Between fragmented supply chains, inflation uncertainty, shifting central bank policies, the baseline of global volatility has simply shifted upward.
So hedging is no longer a luxury.
No, it's a daily operational necessity.
Wow, so people are trading nearly 30 million contracts a day, basically, just to survive the current economic climate. Which brings us to the obvious question. How is CME actually monetizing that survival instinct?
By taking a very small cut of a very big pie.
Right, because they are taking a tiny slice of every single one of those transactions. In Q2, their total clearing and transaction fees were $1.4 billion, while the tables list it at exactly $1,352.5 million. And this brings us to a really interesting metric called the average rate per contract, or RPC.
Right, the RPC.
Yeah. So for Q2, CME's overall RPC was just under 68 cents.
Which sounds cheap.
It does. But that 68-cent average is incredibly deceptive, isn't it?
Oh, completely deceptive. It hides a wildly diverse pricing structure that depends entirely on the specific asset class being traded. The fee you pay to trade an interest rate derivative is vastly different from the fee you'd pay to trade, say, a barrel of crude oil or a bushel of wheat.
Yeah, I was actually looking at this breakdown and I came up with a way to visualize it. I want to run this by you.
Go for it.
So think of CME like a massive grocery store.
Right.
In this store, your interest rate products are the milk and eggs. They are absolute essentials. Every bank, mortgage lender, and corporation needs to hedge against interest rates.
Yeah, absolutely.
And the volume is massive, 14.5 million contracts traded every single day in Q2. But because they are so standardized, and frankly because CME actually faces some competition in that space, the profit margin per item is tiny. The RPC for interest rates is the lowest in the entire company at just 48 cents per contract.
That is the ultimate volume play right there. You make your money on the sheer scale of the foot traffic. When half your entire daily volume is just interest rates, 48 cents per contract adds up to hundreds of millions of dollars very, very quickly.
Right. So meanwhile, the agricultural commodities and metals, those are your imported artisanal organic cheeses.
I like that.
The foot traffic is way lower. Agriculture only saw about 2 million daily contracts in Q2, but they make a massive margin on every single slice. The rate per contract for agriculture is a staggering $1.42. Metals are right up there too at $1.31.
Huge margins.
Yeah. And then sitting right in the middle, you have energy, which is like the premium cuts of meat, 2.6 million daily volume at a very solid $1.13 per contract.
That analogy actually perfectly illustrates how they've built a nearly bulletproof revenue engine.
How so?
Well, what that diverse product mix does is it acts as an incredible internal hedge for CME's revenues. Financial markets are deeply cyclical. There are times when central banks lock interest rates in place for years, and rate volatility basically drops to near zero.
Right. Nobody trades if the rates aren't moving.
Exactly. But if interest rate trading ever slows down, CME isn't left exposed. Their pricing structure in energy and agricultural commodities is designed to pull heavy weight on the bottom line, even on much lower volume.
Because the margins are so thick.
Right. The complexities of physical delivery for agriculture, or the bespoke risk of precious metals, allows them to charge those premium rates. Conversely, when geopolitical events cause energy prices to spike, that segment generates massive fees.
So they always win.
Pretty much. They've built an ecosystem where no matter what the global economy is doing, whether inflation is raging, supply chains are breaking, or rates are shifting, some aisle in their grocery store is experiencing incredibly high demand.
It really is a supermarket of risk. But, if we stop here, we're really only looking at a financial toll booth. A modern exchange is way more than just a place that charges you 48 cents to cross the bridge.
Very true.
We need to look at how CME monetizes the actual information of those trades and how they keep clients locked into their ecosystem. Let's look at the data revenue first, because market data revenue surged 20% to a record $238 million for Q2.
A 20% jump is wild.
Right. For a legacy financial institution in a single quarter, that is wild. Is selling market data essentially the ultimate recession-proof moat? Like, even if an institution decides to trade less on a given day, they still have to pay for the data feed just to see where the market is, right? You can't navigate without the map.
Exactly. I mean, if we connect this to the bigger picture, in modern finance, data isn't just a byproduct of trading. It is the product itself. Algorithmic trading firms, global banks, quantitative hedge funds, they all require split-second, historical, and real-time data just to keep their models functioning.
So it's sticky.
Incredibly sticky. It's a recurring revenue stream. You can choose not to execute a trade today, but you cannot choose to turn off your data feed and just go blind in the marketplace.
Because if you turn off the data, your trading algorithms break.
Exactly. That 20% growth to $238 million reflects just how hungry the market is for high-quality, actionable data, regardless of whatever the broader economic weather is doing.
And they are building out entirely new tools to generate even more of that data. The report mentions a pretty deep innovation pipeline. They're rolling out 2047 one-ounce gold contracts. They've got single-stock futures. They are expanding U.S. Treasury clearing.
Lots of new products.
Yeah, but they specifically mentioned introducing something called compute futures.
Ah, yes.
What on earth is a compute future? Like, how do you trade computer processing power?
It's wild, isn't it? Compute futures are a fascinating look into where the global economy is actually heading. Yeah. They're essentially financializing new forms of scarcity.
Okay, unpack that for me.
Well, think about the artificial intelligence boom. The most valuable commodity for an AI startup isn't necessarily office space or even capital. It's processing power. It's access to massive arrays of GPUs to actually train their language models.
Oh, wow. So computing power basically becomes a physical commodity, just like oil or wheat.
Precisely. If you're building a massive AI model and you know you will need 10,000 GPUs in 6 months, you are exposed to massive price risk. If cloud providers raise their prices, your business model just collapses.
So they use a futures contract.
Right. A compute future allows that company to lock in the price of computing power today for delivery 6 months from now. If the price of compute goes up in the real world, their futures contract pays out, which offsets the extra cost. By creating these contracts, CME is really positioning itself at the very foundation of the AI economy.
That is genuinely brilliant. But the thing that really stopped me in my tracks in this report wasn't the data revenue or even the AI futures. It was a completely different number.
Let me guess. The margin efficiencies.
Yes. Terry Duffy mentioned that CME provided over $95 billion in daily margin efficiencies during the quarter. $95 billion every single day. We need to break down what a margin efficiency actually is and why that number is the key to their entire empire.
Yeah, this is basically the invisible glue that holds their entire business model together. When an institution trades derivatives, they don't just shake hands and say, "I promise to pay you." They have to put up collateral, which is called margin, to prove they can cover their potential losses.
Right. It sits in an account acting as a safety net.
Exactly. Now, if you are a massive global bank, you might have tens of thousands of different positions open at the exact same time across all sorts of different asset classes.
So you might be betting that, say, European interest rates will go up, but you're also holding a position betting that U.S. interest rates will go down.
Right. You have positions that naturally offset each other's risk. And because CME Clearing acts as the central counterparty to all these trades, they have a bird's eye view of your entire global portfolio.
Oh, I see where this is going.
Yeah. So instead of making you put up millions of dollars in margin for every single trade individually, they look at your net overall risk. They run the math and say, okay, this European trade actually cancels out the risk of that U.S. trade. Your overall risk is quite low, so you don't need to post cash for both.
Wow.
And that mathematical netting process saved clients $95 billion in capital every single day in Q2.
I mean, think about the real-world impact of that. That is $95 billion that those banks didn't have to leave sitting dead in an escrow account earning zero return. They could take that freed-up cash and lend it out, invest it, use it to fund operations.
Exactly.
At a 5% interest rate, freeing up $95 billion generates massive real-world profits for those clients just for using CME's platform.
And this is exactly why it is the ultimate economic moat. Imagine a competitor exchange comes along and says, hey, we'll charge you 10 cents less per contract to trade your interest rates with us instead of CME.
The institution will look at that offer and laugh.
Wow, they really would. Because moving their trades to a smaller exchange means losing the portfolio netting effect of CME's massive centralized liquidity pool. The capital they would have to lock up in margin at a smaller, fragmented exchange would cost them far more in lost opportunity than whatever pennies they save on transaction fees.
So CME isn't just a platform. They are holding a $95 billion moat around their business that makes it just economically irrational for clients to leave.
Economically impossible, practically.
Okay, so they have record revenues, they have deep data moats, massive volume, and clients who literally cannot afford to leave. Those things inevitably generate massive cash piles. If we shift over to capital allocation, how is management actually spending that cash? Because looking at the balance sheet as of June 30, they are sitting on $2.3 billion in cash compared to $3.4 billion in long-term debt.
Right. They are incredibly well capitalized, and they are returning a massive amount of that cash to shareholders. The shareholder return numbers are just huge. They paid out $468 million in dividends during the second quarter alone.
Yeah, but the number that really jumped out to me was the share repurchases. They bought back $695 million in CME Group common stock in a single quarter.
It's a big number.
It is. And look, I see they bought back nearly $700 million in stock, and I have to ask, is it just me, or does that signal a massive lack of imagination? Like, are they just out of external acquisition targets in a heavily consolidated exchange industry so that they literally have no choice but to buy their own stock? Or is management signaling ultimate confidence in their own valuation?
You know, it's a debate that surrounds almost every mature monopoly, really. It is likely a bit of both. On one hand, spending $700 million in 3 months definitely signals immense confidence in their future cash flows. But you're absolutely right to point out the industry landscape.
Because it's so consolidated.
The financial exchange sector has gone through decades of intense, aggressive consolidation. CME itself is the product of merging the Chicago Mercantile Exchange, the Chicago Board of Trade, NYMEX, and others. There simply aren't many large, regulatory-approved targets left for them to acquire.
The government probably wouldn't even let them buy another big exchange at this point.
Exactly. When you generate billions in free cash flow and the government likely won't let you buy your biggest rivals, returning capital to shareholders through aggressive buybacks is really the most efficient lever you have left to drive up earnings per share.
It shrinks the pie, so every remaining slice is worth more.
Precisely.
Well, it's not all sunshine and stock buybacks, though, because the risk factors section of this report is extensive. They mention the ever-present threat of cyber attacks, which, makes complete sense when you basically run the plumbing for the global economy.
Right, a huge target.
Yeah. And they mention their reliance on third-party distribution partners, like independent software vendors and brokers. But the risk factor that really caught my eye was a massive technological shift they are undergoing. They specifically cite their transition to Google Cloud. Wait, isn't the whole pitch for cloud computing that it's cheaper, faster, and more efficient? Why are they listing moving to the cloud as a major financial and operational risk?
That's a great question. And it comes down to the stakes and the mechanics of latency. Moving a financial exchange to the cloud isn't like, uploading your photo library to a server.
I would hope not.
Right. It is like trying to replace the foundation of a skyscraper while the building is fully occupied. For a long time, financial exchanges relied entirely on proprietary, physical on-premise hardware. They literally owned the servers and the cables because they needed absolute microscopic control over latency.
Because in high-frequency trading, if a trade takes 1 millisecond too long to execute,
arbitrage opportunities vanish, and millions of dollars are lost. Speed is quite literally money.
Wow.
Absolutely. So moving to a public cloud infrastructure like Google Cloud is a radical paradigm shift for an exchange. You are moving from a closed physical system to a shared digital environment. During the transition, you can't just flip a switch on a Friday night and hope it works on Monday morning.
That would be a disaster.
Total disaster. You have to run both the legacy physical systems and the new cloud systems completely parallel for a long period to ensure the microsecond matching engines don't break.
Ah, and that explains the specific warning in the report. They highlighted the risk of minimizing the duplicative costs of maintaining both on-premise servers and the Google Cloud environment, because they are paying for two massive infrastructures at the exact same time.
Precisely. And it fundamentally changes their financial model, too. When you own physical servers, it's a fixed capital expenditure. Once you buy the server, Running it at 10% capacity or 90% capacity costs roughly the same.
Right.
But in the cloud, costs are variable. You pay for the compute power you actually use. If market volatility explodes and trading volume spikes unexpectedly, their cloud computing bill will spike right along with it. Managing those variable costs while executing a flawless technical migration is one of the biggest execution risks the company faces over the next few years.
It's just a monumental undertaking. So if you are looking at all this data, what are the core takeaways here? I mean, we just watched a company turn immense, sustained global volatility into a record-breaking first half of the year.
Yep.
CME Group has successfully balanced a massive volume, low-margin interest rate business with a lower volume, high-margin commodity business. They are growing a highly lucrative, recurring data business at a 20% clip, and they're generating so much cash that they returned over $1 billion to shareholders in Q2 alone, all while attempting one of the most complex technological migrations in financial history.
That is the complete picture. They have transformed global economic anxiety into a highly structured, highly profitable operation.
You know, for the listener out there, you might be thinking you've never traded a futures contract in your life. You might not care at all about the average rate per contract of an agricultural derivative, but the platform we just broke down is the invisible infrastructure of your daily life.
It really is.
The interest rate on the 30-year mortgage you just signed, the price of the gasoline you put in your car this morning, the cost of the wheat and the bread on your dinner table. Those prices aren't magic. They aren't set by politicians. They are discovered, negotiated, and locked in by institutions trading on the very plumbing we just examined. CME Group is the room where those prices become reality.
It is the ultimate price discovery mechanism for the physical and financial world. And as we've seen with things like compute futures and cloud migrations, that room is getting more complex, more data-driven, and much more ingrained in the digital infrastructure of the future.
Which leaves us with one final puzzle to mull over. Look at their explosive 20% growth in data revenue. Look at their focus on financializing artificial intelligence through compute futures. Look at this massive, risky, but totally necessary infrastructure shift to Google Cloud.
Where does it lead?
Exactly. We still call CME Group an exchange today, but a decade from now, will we look back and realize they had already transformed into a pure technology and data monopoly, a reality where the actual trading of agricultural and interest rate contracts was just a byproduct used to generate the data that they sell back to the world.
That is a fascinating thought.
Keep that in mind next time you check the markets and look for that simple green or red line. Remember, it's not a thermostat, it's a massive pressure system. Thank you for joining us for this deep dive into CME Group's Q2 earnings. Make sure to follow the show for daily earnings coverage and more in-depth analyses of the invisible forces shaping our world. We'll see you next time.